Thank you all for joining today's webinar. We're just going to give everyone a few minutes to filter in and then we'll start. Good afternoon, everyone. Thank you all for joining. I am joined today by Chris Brown, the CEO and co-founder of Tax Hive. I really appreciate him joining in conjunction with their partnership with RCN Capital. So I'm going to turn it over to Chris to talk today about forward tax planning. Take it away, Chris.
Well, thanks so much for having us on and inviting us and giving us the opportunity to share hopefully some valuable insight with your clients and point you in the right direction. I'm certainly hopeful that as we come away today that I'm able to give all of you at least a handful of actionable items that will help you save money on your taxes. You know, at the end of the day, as you all know, creating wealth isn't so much about what you make, but it's about what you keep. And taxes is such a silent killer of wealth and of wealth growth. And we want to look at what we can do to retain as many of your hard-earned dollars as you can, legally, morally, ethically, make sure that we don't get in trouble here. And at the end of the day, put you in a situation where you have more dollars to use, to grow, to invest, and to do things with. So with that said, I'd love to jump in and kind of get right into the meat of what we want to talk about here today. Whenever we do a training, legal always wants me to share a quick disclaimer. So I'll share that with you here as we jump in. The presentation you are about to view is brought to you by Tax Hive. The information contained in this presentation is not intended to provide legal, tax, investment, or financial advice. All information is educational and intended only to assist in financial organization and decision making, and is broad in scope. Each personal financial situation is unique, and information contained in this presentation may not be appropriate for all individuals in all situations. Before making any final decisions or implementing any financial strategy, consider obtaining additional information and advice from accountants or other financial advisors who are fully aware of individual circumstances. This presentation may include case studies, examples, and hypothetical scenarios used for illustrative and education purposes only. You should not view these examples as common, typical, or expected. Each personal financial situation is unique and actual results vary significantly and depend on many factors. In short, your situation is unique, and how this plays out for each of us is different. So we're going to talk in some generalities that will apply to the masses, but at the end of the day, what that equates to on the actual tax savings, on the actual implementation, is going to boil down to your unique situation. To give you a little bit of background as to who we are and how we came about, our group has done business with Kevin O'Leary for a number of years. And we saw this tremendous need as business owners ourselves and for our clients as we service small business owners, as we service real estate investors, as we service kind of this niche. We saw that there was a tremendous need for tax help. And so we went and pitched Kevin on the idea of doing something for this small business owner, this investor in our world, that would help them keep more money in their pockets. And unbeknownst to us, Kevin had actually owned a previous tax business, and he said, I would love to do this again. I'm so committed to helping the small business owner, and I see the need. I'd love to be part of it. So with that said, I want to share just a quick message from Kevin about what we do, and then dive into it and break it down for each of you.
Everybody knows that I'm an advocate for small businesses. I've been investing in entrepreneurs and working with them for decades. One of the biggest challenges any small business owner has is managing for taxes. You're always so laser focused on growing your business that dealing with Uncle Sam becomes an afterthought. That is the biggest mistake you can make from day one. You have to be planning for taxes. And they don't mean showing up at your CPAs at your end with a shoebox full of receipts. If you want to lower your tax bill and keep more of your own capital, you need to plan forward for your tax bill. I think small business owners should have the same tax advantages that big businesses have, but at an affordable price. For my own businesses, I use professionals who understand the tax code, asset protection, and estate planning. And that's exactly what my partners at Tax Hive do. They help small businesses with the same services that large businesses use. It means tax forward planning, estate tax structure, federal, state, and payroll tax preparation. This is the way to get efficiency in your business. And with continued and sustained tax and payroll compliance, you can significantly reduce the risk of terror or an IRS audit. Nothing distracts a small business more than a letter from the IRS. The tax code was written to help small businesses succeed in filing their taxes in a compliant manner year in and year out. It's how you work with it. If you want to help your business and protect your family's assets, give Tax Hive the mandate to be a partner in planning and filing your taxes going forward. I'm an investor in Tax Hive because you know what they say in life. There's two things you can be assured of: debt and taxes. I can't do anything about number one, but I'm sure you know how to make life on earth less stressful when it comes to tax preparation. That's Tax Hive. Give them a call and let them go to work for you. You see what I mean? Everybody knows.
So as you can tell, Kevin gave you a quick background. We specialize in helping the small business owner or the investor. That is really the key to what it is that we do. As you noticed, hopefully in that video as well, Kevin talked a lot about planning, about not just showing up at the end of the year with a shoebox full of receipts and hoping to save money on taxes, but actually planning and putting together the right structure and the right process. At the end of the day, we really believe in businesses. Kevin's DNA runs through our core, and we want to help the investor, the business owner, retain dollars. The specialty that we have is really focused on coming in to individuals like you who are investors and helping you put a plan in place that's going to help you keep those dollars in your pocket. So kind of a quick analogy here. I've got a daughter, just graduated high school. She's a dancer, dances a ton, even more than I played sports growing up, and she just spends a lot of time dancing. Well, she developed this little issue on her ankle at the beginning of the year. It was causing her issues and challenges. We went to our primary care physician and then to another doctor, and they kind of gave us this, well, we're not sure what's going on look, and we didn't really know what to do about it. And we didn't get anywhere with it. And then we finally got into the right doctor. We finally got a referral and we got to the right person. And instantly, he was able to identify what was going on with her ankle. It was a ruptured cyst. He said the only way to fix this is a surgery. So we got in, we did a surgery. It was a little more extensive than we'd hoped for, but she came out and she's healing up really well. The surgery happened just a few weeks back. My point in sharing that is this. The first couple doctors we went to weren't bad doctors. They were great doctors, but the issue that she had wasn't their specialty. The issue that she had wasn't something that they were going to be able to fix. But once we got to the right person, they were able to identify quickly and put us on the right course to find a solution. And I think taxes is the same way. We all know brothers, sisters, friends, grandparents, kid who does taxes, a next door neighbor. We all know somebody. And I'm not saying that Tax Hive is the only group that can help small business owners. We're not. We're not the only group that can help investors. We're not the only group that does great work. There's a number of groups out there that do. But at the end of the day, I hope your first takeaway from today is let's just make sure that you're aligned with a partner who can actually help you navigate things correctly, with a partner who specializes in the way that the tax code is written for small business owners, for investors. So what do we want to cover today? First off, I want to talk about what do you need to know about taxes. Second of all, what's the best approach to save money on taxes? And third, I want to actually talk about some commonly missed deductions to make sure that you're not leaving money on the table. Now, there are so many tax deductions available. In fact, when we run analytics on a business, we look at well over 1,000 possible combinations, deductions, strategies. So we're certainly not going to cover all of them today, but I want to highlight a few kind of low-hanging fruit areas that we see investors miss out on so frequently. So let's start by talking about the tax code. I think it's incredibly important to understand why things are put together the way that they're put together to help you and I understand our role in being able to get out and take advantage of what's there for us. So number one, the tax code was simply written to incentivize investing. And we can argue all day long about politics and different things, but at the end of the day, at the heart of the tax code, it is designed to drive you and I to invest into the American economy. Well, why is that? Why have they gone out and put us in a spot to incentivize you and I? Well, here's the numbers. And again, this is a bipartisan issue. This isn't left or right. That's not what we want to get into. But here's what we know. We know that 2/3 of new jobs created in the United States are created through the small business owner. We know that 40% of economic activity is created by that same group. And the politicians know this. So as much as they might posture about how much money Amazon's making or somebody else, they know that the individuals like you and I are the ones that drive and fuel the economy. So what have they done? They've written a tax code that incentivizes you and I to invest. On the flip side, what's the IRS? Well, the IRS is simply a debt collection agency. And they're the biggest, most powerful debt collection agency on the face of the planet. They have more resources at their fingertips to collect than anybody else. So our job, or their job is to collect money. Our job is to reduce and minimize our taxes. So why do I share this? I share this to begin with because I think the second lesson, if we're to number the lessons here today, that I hope you'll understand is even if you have a terrific tax partner, as investors, as business owners, our job is that we have to be involved in the process. We have to be engaged. The tax code and the opportunity is there. There are ways to lower our tax bill, to pay fewer dollars, and to minimize what we pay legally, morally, ethically, but we have to be engaged in the process. Simply burying our head in the sand and coming up at tax time once a year isn't going to effectively get us to where it is that we want to be. So let's talk about what the right approach is. As you noticed in the video there that I shared with you, Kevin talked about tax planning a lot. He must have mentioned it 4, 5, 6 times. In all of his businesses, it isn't just about great preparation or great compliance, as we call it, but it's about putting a plan together so that throughout the year, we can execute that plan. Well, when's the best time to have a plan? Today. You know, there's the old saying, when's the best time to plant a tree? Well, it was 20 years ago, but if we didn't get it planted, today's the best time to do it. And I think taxes are very similar. When's the best time to have a plan? Right now is the best time to have the plan because right now is when we're going to be able to impact what we do. When you think about it, we're already halfway through this year. I know that's hard to believe. We've got the 4th of July just around the corner. We're sitting in a spot where we're halfway through the year. So when do we want to plan? We want to plan right now so that we have time before the end of the year to implement that plan, to execute that plan, to do the things that we need to do in order to save money. Because at the end of the day, we need to implement. As great as a plan may or may not be, we have to implement the strategies in a plan in order to take advantage of it. The great thing about this is one of those things that compounds year over year over year over year. If I implement a strategy today, there's a high likelihood that that strategy is going to carry on next year and the year after and the year after. So every ounce of energy put in now to reduce our tax liability is going to pay dividends long into the future. So I want to just share a quick analogy about the kind of stuff that I'm talking about and why this matters so much. I grew up in the 90s. I'm a child of the 90s, and as many of you will remember, the Chicago Bulls absolutely dominated basketball in the 90s. They beat my Utah Jazz in a couple of finals, and as much as I hated the Bulls, I loved to watch them play. They were amazing. And like many of you, I remember growing up, and I remember not giving Phil Jackson any credit. I remember looking at Phil Jackson and saying to myself, man, I could win a championship with that team. Anybody could win a championship with that team. Well, just a couple years ago, there was this great documentary that came out called The Last Dance. If you haven't had a chance to see it, you should go watch it. And it documented the final championship that the team won before they broke up. I gained an entirely new appreciation for the role that Phil Jackson played in all of this. It was amazing to watch. Now, there is no doubt that Michael Jordan, Scottie Pippen, among others, executed the game plan and hit the shots and won the championships. But I'm convinced that without Phil's input and without Phil's direction, they wouldn't have. There's a few lessons in all of this. I remember watching, and Phil, from game to game, was the one who spent hours watching film and developing the game plan. It was Phil in the middle of the games that called the timeouts, that adjusted the plan, that tweaked the plan, that moved the defensive scheme or the offensive scheme to fit what was happening. It was Phil that during the season knew when to give a guy a break or when to press on a guy a little bit harder. It was Phil during the playoffs that built the plan that the team went out and executed. So why does all of this matter? The analogy, coming back to what we've been talking about, I think are a few things here. Number one, once the champion's crowned, there's not a lot you can do to impact the game. Just like a finals series, once the year is over with taxes, there's not a lot that we can do in the rear view mirror to execute, to implement, to reduce tax liability. It's during the season that we have the biggest capacity to impact, and we're halfway through. Number two, we've got to make in-game adjustments as our circumstances change. Team to team, player to player, injury to injury, as things change and things adjust in how we invest in the income we're bringing in and what we do, we need to make in-game or in-season adjustments. We're halfway through the year. Now's the time to put the proper game plan, the proper pieces in play. Thirdly, you're the players. As investors, as business owners, you're the players. And there's this symbiotic relationship between Phil Jackson, Michael Jordan, Scottie Pippen. Again, they had to hit the shots. You've got to implement, you've got to execute. As we talk through some specific strategies today, you'll see your role, but you'll also see the role of a great planner, of somebody who gives the direction, of somebody who's playing that role as head coach and directing traffic, so to speak, as we go along. So with that backdrop, with that kind of understanding, with that direction, what I'd love to do now is actually jump in and talk through some specific strategies, some specific ideas of things you could and perhaps should be doing to save money, to reduce your tax liability. And I want to show you the real world impact that these strategies have as you layer strategy over strategy over strategy. Now, to be clear, not every one of these strategies will apply to every one of you, but I'm going to highlight a number of common strategies we see. But here's what I know. If this specific strategy doesn't apply to you, there are strategies that apply. We haven't found a client yet that we've worked with that there aren't strategies that apply to that client. At the end of the day, we know out of thousands of potential combinations of tax deductions, when you get out and dig into what it is that you're doing, the potential is tremendous. So even if the strategies I don't share with you today, as you look at them, maybe you feel like, hey, that one doesn't work. Well, don't panic. There are hundreds, thousands of others. The point that I want you to pick up on is this. There are strategies. There are an endless amount of strategies, and your job is to get the right ones in place to help you lower your taxable income and bottom line save money on your taxes. So let's jump in. The first thing I'd love to talk with you about here today is the home office deduction. Now, when we talk about the home office deduction, especially in this world of COVID, this is something that has just really blossomed and really exploded. It seems like everybody now is working out of their home. So let's talk about a couple different ways that you can take advantage of the home office deduction. The first is called the simplified method. It is straightforward, it is easy, it is simple. All you do is you take the square footage of your office, you multiply it by $5 per square foot, and you take a maximum deduction of $1,500. You don't have to track anything. You don't have to track any expenses. You literally measure the square footage of the office. At $5 a square foot, you're able to take that deduction and write that off on your taxes. Then there's the regular method. Candidly, this is the method that we like the most, and most often, this is the method that we recommend to our clients. What do you have to do? You have to establish what's called a business use percentage to begin with. So what do? You take the square footage of your office, you take the square footage of your home, you simply divide it, and you come up with what percent of your home does your office represent. Typically, we find it to be about 8 to 12%. 8 to 12% is usually where things fall. Now that you've got a percentage of what your office space to your home, you're able to begin taking direct expense deductions and a percentage of indirect expenses. So what does this mean? Things that are a direct expense to that home office, you put a chair in it, you can take that direct expense. You put a computer in it. Those kinds of direct expenses, you're able to simply take the full amount. But where this gets fun is you're able to deduct a percentage of indirect expenses. You're able to take deductions on mortgage interest. You're able to take deductions on your power bill, your utilities, your insurance perhaps. You think about a home. Let's say I go out and I have to replace my roof on my home. Well, you can't just replace all of the roof except over the home office. You've got to replace the whole thing. So now you're able to take the percent of that expense deducted off of your taxes. Now, people often ask, Chris, which is better, the simplified method or the regular method? And you're going to hate my answer. My answer is it depends on your situation. Certainly, we find that most often the regular method equates to a better savings and a greater tax deduction than the simplified method. But what you want to do your first year is you want to run the numbers. You want to track the expenses. You want to figure out the business use percentage, and you simply want to run the numbers and find out where you're going to get the bigger deduction, and then that's simply what you go with. Now, there are a couple things that you need to know in relationship to the home office deduction. Number one, the office must be devoted to business use. So what does this mean? I can't set up on my kitchen table, run my business off of my kitchen table, and then deduct the kitchen square footage. This has to be a dedicated area that I run my business from out of my home. Number two, it's got to be the principal place of business. It doesn't say the only place, but it's got to be a principal place of business. Again, especially with what's happened with COVID, Zoom calls, meetings, all sorts of different things happening out of your office constitute running your business out of your home office. You don't have to physically be meeting with clients there to be able to consider the principal place of business. If you meet those criteria, most likely you should be taking the home office deduction. Well, why does this matter? Again, I want to break down real world examples for you here and show you why you should care about taking advantage of these deductions. So let's look at Sarah. Sarah's an actual client of ours. She runs a real estate business. Her income was $92,000. So she's making a decent amount of money, but certainly isn't one of these people making millions of dollars. With that $92,000 income, we were able to utilize the home office deduction. Her business use percentage of that office was 9%. So what did we do? We took the percent of real estate taxes, mortgage interest, utilities, improvements, equipment, furniture, and at the end of the day, this equated to a saving, or a deduction, excuse me, of $6,273. Again, that actual expense was significantly higher than the simplified method, so we took the deduction of $6,273. Remember, this is one strategy over 1 year. As we layer multiple strategies and use this strategy year 2, year 3, year 4, in 10 years, that's $62,000 worth of deductions by simply implementing one strategy, the home office deduction. Now let's look at another strategy. I want to talk about the S election strategy. We often get asked, how are LLCs taxed? Everybody's heard of an LLC. They get excited. It's an easy business entity to set up. It's a great place to start. What most people don't realize is the LLC is not a tax vehicle. There isn't a tax code written specifically for LLCs. LLCs are going to be able to be taxed in different ways. This is the beauty of an LLC. It's kind of this chameleon that allows you to figure out how to get taxed. So if I own it and it's just me, I can treat this as a disregarded entity or a pass-through entity, and I can just roll the income from my business over into my personal tax return and take it there. If it's a multi-member LLC, then it's going to be taxed as what's called a partnership, meaning there's multiple people. That income can again flow straight through to our personal income and separate it out into the percentages of who owns what. Well, here's where the election gets exciting, the LLC gets exciting. The LLC can be taxed as a corporation. You can elect to tax it as a corporation, and you can choose to now abide by the taxation rules of a C Corp, of an S Corp. So when and why might we want to take this? Here's kind of some general rules of thumb. If you have a business that's generating over $30,000 a year in net income, looking at the S election becomes something that we want to take a serious look at. Why? Because taking the S election allows you to save 15.3% self-employment tax. When you're just passing that money through to yourself, you're paying self-employment. When you change over or convert to an S Corp, you don't change your entity structure, you leave it an LLC, but now you elect to be taxed as an S Corp, you're able to avoid that self-employment tax. Now, when you do this is important. You can do this when you set up your LLC. You can do this in the first 2 months and 15 days of every year. There's an open enrollment to take the S election. Most commonly, though, we see our clients take this as a late election. What that means is when we do your taxes, when we file your tax return, if you haven't taken that S election, we can take it that first time when we file taxes and claim the benefits for that previous year. This is one of those things that even after tax time, we can see some benefit in. With that said, there's a couple really important things that you need to know about taking the X election. Number one, if we're going to take the S election, even if we're going to take it late, you have to put yourself on payroll. So if I want to take the S election next year, this year, I've got to put myself on payroll. The IRS likes to give some real vague rules. So what happens is I must pay myself a reasonable compensation. So I'm going to take a reasonable compensation for the duties that I perform inside of the company. We want that income, that compensation to be as low as we can reasonably justify, because we do pick up some taxes that we have to pay when we pay ourselves through payroll. Lastly, there's 2 returns that now need to be filed when we take the S election. We don't just pass that income through, we have to file 2 returns. So when you look at this little chart we have here, anybody who's making money understands this. When you look at the percent of income or percent of businesses, the vast majority of them are set up as sole proprietors or partnerships. 82% of them are. However, when you look at the percent of business revenue, it completely flip-flops. 82% of revenue comes through corporations. When you begin to make money, as you begin to make money, anybody worth their weight knows that changing to be taxed as a corporation generally saves money. So again, let's look at how this actually falls out and how this plays out over time. What's the real world impact of what it is that we're talking about here? So I want to look at another actual client, Austin from Texas. Austin is an internet marketer. He runs some online marketing. He had a gross income of $100,000. As you take the deductions, exemptions, exclusions, his net income came down to $48,469. So what does that mean? If tax is a Schedule C, just pass-through income, he would have paid a little over $7,400 in self-employment tax. As we took the S election for him, we were able to reduce that self-employment tax to a little over $1,500. This equates to a net savings of $5,885. Again, nearly $6,000 in savings. This wasn't some big lift that he had to do. He had to put himself on payroll and take a reasonable salary. By simply doing that, he was able to save $5,900. Now that number will grow as his income grows, but I want you to remember, year over year over year, that savings adds up. And when you look at this S election, I want to point out to you That's not a deduction of $58.85. That's actual cash, actual tax dollars in his pocket of nearly $5,900. Now another one, depreciation. This is one of our best friends, right? The IRS allows deductions for the full price of certain assets purchased for business purposes. The Tax Cut and Jobs Act, as well as Section 179 of the tax code, opens up some exciting things. So we know as investors, we can take a piece of real estate and depreciate it over time, right? We can split that up and we can depreciate over time and get a great tax savings. Section 179, though, allows us to accelerate depreciation on certain assets purchased for business purposes. So this is where a 6,000-pound vehicle comes into play, right? You've all heard about buying a vehicle and you've heard this magic number of being over 6,000 pounds. Well, why is that? Why does that matter? If I purchase a vehicle under 6,000 pounds, normal depreciation applies. But if I purchase a vehicle over 6,000 pounds, accelerated depreciation kicks in, and I can potentially write off that entire cost of the vehicle year one. So there's a couple things here again to be aware of. We've got to figure out the business use percentage. If I use it for 60% of the time for business and 40% for personal, I can only take 60% of that expense. So we want to track our business use percentage. So here's a little tip for you. If you're going to purchase the vehicle, it begins, the ability to depreciate and capture that deduction begins in the year the vehicle was placed into service. So when would be a good time of year to place a vehicle into service? In my mind, December would be a fantastic time. Why? Because in December, I can be real diligent about how much I use that vehicle for the business. I can track it and I can work real hard to track and to use that business or that vehicle for business purposes. And then I can factor my business use percentage for that year off of how much I use the vehicle in December. Now, you may not want to write off the entire vehicle year one, depending on your income, but you can. So let's just, again, break this down for what this means. What this means is if I went and purchased a $100,000 car, and we all know that cars go for an arm and a leg these days, I place it into service in December and I used it strictly for business. Come tax time, I'm now entitled to a $100,000 deduction on my taxes, even if I finance the vehicle. Did you pick up on that? Even if I didn't pay out the cash, but I acquired that vehicle, that $100,000 vehicle, and I'm making payments on it, Section 179 still applies. Now, here's an exciting, quick little side note for those of you that are investors, that love to invest, that have rentals, that have VRBOs. In this code change, there's this interesting little change in the code. And one of our partners had a client that he was working with, and as they planned together and they figured out what to do, they realized that high-end boats, yachts that were used to rent out, think VRBO for yachts, could now qualify for the same kind of depreciation that vehicles over 6,000 pounds qualify for. So this client went out, bought a yacht, signed up for a service that would rent out the yacht just like VRBO would, and that yacht equated to a nearly $2 million tax deduction that very first year. Now, you might not be able to go buy a $2 million yacht and place it into a rental group, but the same principles apply. Again, the idea is that we simply need to get out, we need to look at the opportunities we have, we need to put the plan together and take advantage of all of the options that are available to you and I as investors. One of my favorites, the Augusta Rule. Now, this is a rule, the legend has it, it came together because of the Masters Golf Tournament in Augusta, Georgia. The Masters Golf Tournament would come, and these people in Augusta would be able to rent out their homes for enormous amounts of money. But they didn't want to have to claim that money on their tax return. So then came about the Augusta Rule. you can rent out your home and you don't have to claim the income. Now, there's some rules around this. You can only rent it out for up to 14 days per calendar year. So I can't just rent out my home indefinitely, but I can 14 days a year rent out my home, get income, not claim that income, and not pay any tax on that income. So where does this get exciting for us? Certainly renting out my home, I could do it on VRBO or any other way, but we can double dip here. I can actually rent my home to my business. So my business can rent my home from me. It has to be for specific business purposes, and I have to have the rate in line with the going market. So again, let's break this down for a minute as to what this means. Let's say we need to have business meetings. We need to have a monthly management meeting. We need to have a marketing retreat. We need to do something. Well, I can rent my home to my business. My business then pays me. My business takes the tax deduction, but I don't claim the income on the personal side. So again, real world, how does this flush out? Scott from Florida, he's a real estate guy, does some SEO consulting for businesses. He bought a $2 million home right on the intercoastal highway or waterway. Beautiful home. Homes in this area go for a lot of money in nightly rent. So he used code 280A, that's the actual code for the Augusta Rule. He rented his house to his business for board meetings, networking meetings, company trading events, etc. Looking in his area, homes were renting for $1,500 per night that were similar. So he did this 12 times, once per month. That's $1,500 per night. This equated to an $18,000 tax deduction. Again, think about that. One simple strategy like the Augusta Rule being introduced equated to $18,000 worth of tax deductions for Scott. And again, this applies at any level. So a couple tips here. Number one, if you're going to do this, we always talk about making sure that your deduction is defensible. We don't want to take deductions that if we get asked about, we're going to find ourselves in hot water. We want to make sure that we have the information we need to defend it. So make sure that you put an actual rental agreement in place between you and your business. Make sure that you issue receipts for that payment made from the business over to you personally. And lastly, make sure you track evidence of actual business purposes. This could be an agenda of what's going to happen during the day. This could be notes from what happens during the day. This could be photos of the board meeting, the marketing retreat that you're holding, but make sure that you track those kinds of things so that in the unlikely event that you're asked to produce evidence that you actually used this rule the way that it was intended, you're able to produce that evidence. We're coming near the end, and I want to share one of my favorite deductions. It's the qualified retirement plan. Now, a lot of you are business owners. This is something that all of you should sit up in your seat and get excited for when we talk about qualified retirement plans, right? You've all heard of a traditional IRA, you've heard of 401ks, but there are other vehicles that allow us to save far more dollars tax deferred than traditional IRAs, 401ks. There's what's called a SEP IRA and a solo 401k. The limit this year is $61,000 that you can contribute to these qualified retirement plans. And in fact, if you're married and both you and your spouse own the business, you can potentially double that to over $120,000. Now, I remember, I don't know if any of you have had this experience, but I remember when I was much younger, I was sitting in a room with some partners and I was contributing, I don't know what the max at that point was or what I thought the max was. I was contributing $8,000, $9,000, $10,000 a year into an IRA, and I was feeling great about it. I thought I was doing what I should be doing as a young entrepreneur. And one of my partners mentioned that he was putting over $50,000 a year tax deferred into a retirement account. I remember being young. He was a little more experienced than I was. I looked at him and said, "You can't do that. That's impossible. That's over the contribution limit. You can't do it." He looked at me, he said, "Chris, yes, you can." And I argued with him, "No, you can't. Yes, you can. No, you can't." He said, Chris, here's the rules. And he went through the rules of what I needed to do to be able to set aside that type of money. I realized that I checked every single one of those boxes, that I qualified for a solo 401k, and I could have been setting aside far more dollars. I looked at him and I said, where did you figure this out? He said, oh, I have a great accountant that told me. And my mind just about exploded. My head exploded. Why? I had a friend of the family that had been doing my taxes for years. He's a great person. I would trust him with my life. I would trust him with my kids, but he wasn't helping me plan in the least. I remember going to him and saying, hey, I was told about this solo 401k idea that would allow me to put more money aside. Have you ever heard of it, or is this just made up? Then he looked at me and said, oh yeah, Chris, that's a great idea. That's something, man, you probably should have been doing for the last few years. Well, let's start now. And again, I was so incredibly frustrated by the experience that I had, because with a little bit of foresight and planning, I could have positioned myself to set aside far more money than I then had, tax deferred. The great thing about these as well as investors is we can use these qualified retirement plans to invest into alternative assets, real estate, gold, other businesses. There's lots of things we can do with this. I want to break down the real world example here and show you why this matters so much. So here's an actual client, Jaden. He's in the medical field and he qualifies for a solo K. So with a little bit of planning this year, he's set to contribute $61,000. He's going to max out this solo K, $61,000 contribution that's going to save him $24,400 in taxes. Why does this matter? I want you to pay really close attention here for just a minute. Why this matters so much is this. When you look at what he's contributing, that $61,000 number might sound like a lot of money. But you have to realize that $24,000 is already being paid to the government in the form of taxes. So for Jaden to capitalize on this, he really only has to come up with $36,000 and change. And where does the rest of the money come from? It comes from money he's already paying to the IRS in the form of taxes. So he's able to pocket $24,000, put that to work in his investment account, let it grow, tax deferred, and accumulate wealth at a much faster pace. A similar story, Stacy from Virginia. Her situation doesn't allow her to contribute quite as much, but she contributed $9,300 last year, saved her $2,000. This year she's going to contribute $25,000 for a savings of $5,500. Again, the point I want to make here with qualified retirement plans is simply this. Regardless of where you're at, whether you're Jaden or Stacy, there is a play for you in this space. Now, I have kids. I've got 4 daughters, and I love putting my kids to work and letting them work for me. So one of the codes allows us to hire our kids, and we can pay them up to $12,950 per year, and they don't have to pay taxes on that income. Now, they have to perform legitimate work, and the compensation, again, must be reasonable. Well, what can my kids use that income for? They can use that income to pay for all sorts of things that I used to pay for sports, for dance, for school clothes. They can even take that money and put it in an IRA and let that money begin to accumulate for them. When we look at this, there are countless things that kids could be doing for us that we could pay them for. Clean the office, wash cars, data entry, all sorts of things. I want you to get creative here for just a minute. Again, it's got to be legitimate work. So I don't know that I can bring in my 6-year-old, I've got a 6-year-old, and have her clean the office. I don't know that that's going to go over too well. But my wife teaches dance. She helps run a dance studio, and a couple years back, they wanted new photographs of kids to use in marketing campaigns. So what did my kid do? She went up and she was a model for the day. And they took pictures that are still on the side of the dance building. They're still in every publication that they use. And my daughter got paid to model. 6 years old, she might have been 5 at the time. This is my other daughter. She performed a real legitimate piece of work for the dance studio. The dance studio paid her. She didn't pay taxes on that money because it was under that $12,950, and the business still got the deduction. So coming back to where we started, we have to make sure that we're taking the right approach to taxation. We need to take control of our situation. Each of you have the power to reduce your taxes, but we're halfway through the year. We've got to get out and we've got to implement and put the right plan in place so that that compounding effect can begin to happen year over year over year. So one of the things that we want to do, we're so grateful for our relationship with RCN. We're grateful for the opportunity to come on, and we would love the opportunity to earn your business. Regardless of whether you use us or not, I hope and pray that you'll go implement the kind of planning and approach to taxes that we've talked about. But because of our relationship with RCN, we've arranged to give away a free strategy session to anybody who's here on the webinar with us today. All you've got to do is go to taxhive.com/RCN, or simply what I might tell you to do right now is pull out your phone and simply scan that QR code. You'll go to a site, you'll be able to pick a time for a free strategy session. We've done this enough times that we've put a remarkable guarantee in place. We guarantee that in our consultation with you, we will find a minimum of $10,000 in potential tax deductions, or we'll pay you $100 for your time. Now, as you can imagine, Kevin and myself, we're not very interested in giving away a $100 bill, but we know that with just a little bit of time with you, most likely we're going to be able to identify potential tax savings and put extra dollars in your pocket that will help you thrive as a business owner. In fact, we've surveyed thousands upon thousands of business owners, and in our survey, we've been able to identify on average over $50,000 in missing or potential tax deductions. Our experience tells us that the vast majority of investors, the vast majority of business owners are missing out on more money than they can possibly imagine. Think about that. That's $50,000 in missing deduction a year. That's $500,000 over the course of 10 years. These are real dollars that we're talking about. So we've established this guarantee that we will put a blueprint together for you and identify at least $10,000 in missing deductions, or we'll send you out a $100 bill. I don't expect we're going to have to do that for anybody, but that's our guarantee and our commitment to you. So my invitation, again, is simply this. Pull out your phone right now. Take just a minute while it's at the forefront of your mind before you get lost in the 4th of July weekend. Pull out your phone, scan that QR code, go to our website that will pull up, and schedule a time to have a free tax strategy session with a member of our team. A member of our team will get on, we'll spend 15 to 20 minutes with you. Again, we would love the opportunity to earn the time to be together and to be your trusted tax partner. But either way, I would love to deliver this blueprint to every single one of you and set you on the right track, because like I mentioned at the beginning, Kevin's DNA runs through our business. We believe in what it is that you do as business owners. We believe that you fuel the economy, that you're the ones who make a difference, that your investing dollars are what drive this country, and we want to be able to help you out. Whether that's as your tax partner, which I hope it is, or simply by setting you in the right direction, either way, I feel like we're doing something good by sending you out and helping you keep more dollars in your pocket. So scan that QR code. If you don't have your phone on you, just simply go to taxhive.com/RCN, schedule a time to talk, and we would love, love, love nothing more than to see what it is that we can do to help you out. I'm so grateful for your time. I'm grateful for you being willing to take time to spend time with me today. And I hope that we're going to be able to talk to every single one of you, point you in the right direction, help you get on track, and bottom line, help you keep more money in your pocket. So that's the information. I know, like we talked about at the beginning, that certainly if there were a handful of questions, we could take those. I don't know how you want to navigate that. If you want to have them put it in the chat or not, but I'll let you take back over and kind of navigate it for us if that's okay.
Absolutely. Thank you so much today, Chris. That was such a great amount of information about the different tax strategies that our clients can use. I just wanted to note too that this session will be recorded and shared with all attendees. So if they didn't have a chance to scan that QR code, they will have the opportunity to do so when they get this recording as well. Let me take a quick look at the chat to see if there's any questions in there. Also, we will share your contact information too, so that if folks didn't have an opportunity to ask any questions during the webinar, they can reach out to you or reach out to Tax Hive to ask those questions as well. I don't see any questions in the chat, so I think we'll be able to wrap up if that's okay with you. Again, we want to thank you so much for joining today, and we really want to thank Tax Hive for their continued partnership with RCN Capital.
Thank you so much. We look forward to continuing to work with you and your clients. We really appreciate the time.
Thank you so much. Have a great night.
You too.
Bye-bye.